In this video, I'm going to go over some of the accounting terms and also the differences in these accounting terms between private, nonprofit, and public sectors. I realize that this might not be the most exciting topic, but bear with me. It's important for you to understand this in order to be able to understand the rest of the course material. So, the first difference is we want to look at worth. The financial worth of a company. Financial worth of a company is usually looked at as assets minus liabilities. So what is an asset? An asset is, in finance, it's usually property, buildings, equipment, goodwill, maybe like goodwill might be like in-kind donations, like volunteer, or some other measurable holdings of an entity. And liabilities, then, are things that are loans, things that you owe. They're loans or other short-term or long-term debts owed by the entity to other individuals or organizations. I've mentioned this before. The word entity is a legal term for an organization. So it's either a business, a not-for-profit organization, or a government unit. And it has, specific purpose, and it has, it's an accounting unit. So the worth of a company then is assets, the things that you've got, minus liabilities, the debts. So, and you can even think of this personally. So, in my case, assets. Well, you could say have a vehicle. You could say, maybe I own some land or a couple of houses. These would be things that would be assets. Liabilities might be personally would be like a mortgage, a car loan, and any type of, like student loans. All that are liabilities. So in the private sector, we call the worth of a company equity, and that is the value of the company. So you may have heard on, Dragon's Den, they might ask, well, what is your equity? And that they know then, how much worth then. In not-for-profit, though, because they don't use the language of making, it's not for profit, you're not supposed to be making profit, they don't use the term equity. They call it net assets. And that is simply the same thing, assets minus liabilities. So it's the same thing as equity, but in not-for-profit, we call it net assets. In contrast, in the public sector, the government sector, they have to look at fund balances. And the reason they use that term is because, again, they cannot be making profit. So you cannot have revenue. So they call it fund balances because you might have, for example, you might have a city might have a road maintenance fund, a snow clearing fund, a city cleaning fund. They've got the garbage and recycling fund, and they have all these different funds then, and they look then to see the balance of them. So fund balances represent the value in a specific fund accumulated on behalf of taxpayers for a specific purpose. So a fund is simply a group of accounts within an entity for a specific purpose. So even in not-for-profit, they have fund. But for example, a government often has what's called a reserve fund. A reserve fund is when you're saving, money for a rainy day, really. They might have another one might be called a capital fund. Capital usually means creating equipment like buildings. And so that would be like saving money into a fund in order, let's say, for example, to build a new recreation center. So a fund balance then is a term used in government accounting instead of equity. Okay, so they say it's the net worth of a fund measured by total assets minus total liabilities. So a question I could ask you on the exam is, what is the difference, or compare and contrast what the worth or the value of private not-for-profit versus public? And you would say, well, the value of any entity is always assets minus liabilities. In the private sector, it's called equity. In the not-for-profit sector, it's called net assets. And in the public sector, it's called a fund balance. We also then look at the resources of an organization. So, and that's usually like, financial resources that are readily available quickly. Okay, so like money in a bank account, not something, for example, like a house isn't considered, a building is not considered a cash resource because you have to sell it and you can't what's called liquidate it quickly. Liquidate means turn something into cash. So in all of the different sectors, that term is called cash resources. The money resources of an organization. In accounting, there's also different funds. How many kind of accounts, I guess you would say, that they all have. And this separates also then what type of accounting is used, whether it's like, if it's a modified accrual accounting, for example, or full accrual. In the private sector, they have just one fund, it's called. I realized, like the organization might have a whole bunch of different little pockets of money that they call it, but in terms of accounting, it all goes down to the one bottom line, and that is, about the worth of the company. So the equity of the company. So it's viewed as one fund. In not-for-profit, they have multiple funds, and these are separate into operating and reserve funds, generally. They might have other funds, but most not-for-profits have, basically two, and maybe a program one. So they might have an operating fund is money. It's an account that is set aside to meet the cost of the operating the organization. So, like heat, light, full-time, salaried positions, etc. Reserve funds, as I've already mentioned, that's an account set aside to meet unexpected costs in the future. It may be restricted to a certain purpose or used as a savings account for general future purposes. And they might also have like a program fund. For example, like a McMorran Community Center. They get a lot of their operating fund generally comes partly from the provincial government, and then they also get some operating fund from the City of St. John's. That's where all of their money comes from, just to generally operate. Then they probably have a reserve fund, unexpected costs. If the roof leaks or they have to replace toilets or something like that. They probably, though, also have a program fund, and that's usually in not-for-profit world, they're getting that from grants. So the program fund is then, to run extra programs that aren't covered by the operating expenses. And similar to the public sector, not-for-profit, public sector also has multiple funds. Okay, now, but they have tons of them. I won't go in them all. They have, for every single unit and different things, there's tons and tons of different funds. And these are sources and uses of money used to separate to maintain transparency, even though it leads to more complexity. And that's why in government, accounting is like very complex. And I'll just give a little example from, let's say, from the School of Human Kinetics and Recreation. So, at the university, it's public, so there are different funds. And you can, we have, for example, certain funds that are for, salaries, like, and, TAs and all that, paying. So we might actually sometimes not use up all our money in that. Like, let's say someone went on maternity leave, a professor. So they're not making as much money that year. So there's a little bit of money left over. Well, you might think, well, it's usually awesome. Yay, we can use this. But because it's in a specific fund like human resource, sometimes then that means that that money is only allowed for that purpose. Therefore, for example, the dean can't use that money to maybe buy equipment or that sort of thing. The different funds have specific purposes. This makes accounting in the public sector, kind of difficult, and it also makes it bureaucratic, and it also makes it so that because you have basically administrators want to use up all the money they have in a fund, because otherwise the government isn't going to give them that same amount if it looks like they haven't used it all. Which is always why, if you work in government, the best time of year to ask for things is in March, when after they soon have done the, March, April is usually when they realize they have money that they've got to spend, maybe before then, because they submit taxes and budgets in April. So usually in the spring, there's a call from the dean like, oh, got a bit of money. Does anyone need equipment? And the reason is because a fund has not been fully used, and she's got the money left over and needs to spend it so that it looks like we've used all that. Otherwise, our operating budget would go down for that fund. So then the negatives, or the money going out, or debt, whatever, debits, these also are slightly different. In the private and not-for-profit sector, they're called expenses. So money leaving the entity for any purpose that decreases the entity's equity. So debits, but the negatives, they're called expenses. In public sector, though, this term is different. It's called expenditures. And again, I don't exactly know the slight reason, but it has to do with not being able to have profit, and so they call it expenditures, where expenses suggests that you can make a profit. So again, a question might be, I might ask you, which of the what are the term differences in terms of debts or money going out in an organization? And you would say, well, expenses, the term expenses is used for the private not-for-profit sector, whereas in the public sector, it's called expenditures. And actually, I realized from the description, this is often because it's looking at the depletion of cash resources, or what's from funds. The positives, or the money that's coming in, though, it is the same for all of them. It's called revenues. So revenue is anything that is money coming in. It's an increase in cash resources. The same term is used for all three sectors. So when we're looking at what is the total of a, of a company, or, what is the bottom line when it comes to accounting of a fund, we look at the positives minus the negatives. You do this in your own account. At the end of the month, you hope that you have more positive than negative, or you're going in debt. In the private sector, then, it means, because of the different terms, they take in revenues and make expenses. Same in not-for-profit. They take in revenues and make expenses. But in the public sector, they take in revenues and make expenditures. Now, last is the different types of accounting. I will admit to you, I don't fully totally understand all the differences myself. That's not the purpose of this course. It's for us to understand the terms and become knowledgeable so that we can communicate effectively with the public, accountants, and upper level management or government or whatever it is. So you don't need to, for the exam, I'm not going to ask you tons of information about all of these types of accounting. But you should generally understand what the difference is between accrual accounting and cash accounting. And then you need to understand the difference between full accrual and modified accrual. And that's really about depreciation. So we've already talked about what depreciation is. So there's fixed assets. So fixed assets are, by definition, are things that depreciate. But they are fixed assets are things that that do not lose usually value, or they can lose value. Pardon me. So some fixed assets, so you could have land as a fixed asset, but it doesn't depreciate, whereas buildings and equipment do get old or lose up their value. So there's a decrease or loss in the value of these fixed assets because of age, wear, or market conditions. So really the big difference is that in full accrual accounting, they include the depreciation. But in public, they do not look at depreciation at all. That is the major difference. You also need to understand that private uses full accrual accounting, public uses modified. In the previous lecture, I've already mentioned to you that I'm not entirely sure about nonprofit. In the textbook, it says it uses full accrual accounting, but I've also read other things where they call it fund accounting or modified. So I'm not absolutely positive, and it could be a difference between Canada and the US. But full accrual accounting, then, it depreciates assets. Okay, so whereas modified accrual accounting does not. And so it's looking then at it doesn't depreciate, so it doesn't depreciate them in their useful life, but extinguishes them when assets are taken off. So it records transactions that are available and measurable. So in full accrual accounting, because depreciation is a tax exemption for businesses, they include depreciation on their accounting. I'm not sure, as I said, about not-for-profit, but it doesn't really matter because they don't actually pay taxes. So it wouldn't matter if they included depreciation or not. And modified accrual accounting then is for government. It records transactions that are available and measurable, but do not depreciate the fixed assets, recording them in the different funds, okay? So the government accounting method is where revenues are recognized in the period they are available and measurable, and expenditures are recorded in the period where they are associated with the liability. So what that is saying is it explains to us why they don't include depreciation, because they don't look at things over a long term, but it's only in the period where there was revenue or expenditures. So they don't look at things over the long term. So hopefully this gives you some indication then of the differences in accounting, and to understand then that there are differences in the terms. On an exam, I could give you a table that looks very similar to this handout and ask you to fill in the blanks by putting the correct terms where it should go for private, not-for-profit, and public. That would be a good exam question as a short answer for this chapter.